Hello and welcome. You're watching KYC. I'm Harsh Saita. With me is my Vachajani, and today we're going to again continue to look more domestic. And when you look domestic, hotels is one sector which seems to be on an uptrend. We had one of the managements come through a couple of days back when we spoke, and they said that H2, and this is Chalet actually, now that I remember, they said H2 is going to be extremely strong. H1 was slightly subdued due to various factors, including the India-Pakistan conflict of sorts that played out, and the monsoons in certain geographies have been tough. If I recall, those were the reasons he gave. And therefore, one is, of course, the GST benefit, and we're going to be speaking with the Royal Orchid Hotel group today. One is, of course, the GST benefit and how that impacts both occupancy, in their opinion, and other income, because you will have more people coming into restaurants and more people utilizing hotel spaces. So hopefully we'll get a sense of what this does in terms of numbers exactly and demand. The second piece, and I did mention this, occupancy trends for Q1 FY26, of course we'll analyze that. But what about H2 and what is Q2 looking like? We'll just get a sense of that as well. And with this GST rate cut, likely there will be a push with regard to that as well. Let me talk about the third piece. They are planning to triple their hotel count. 350 hotels is what they plan to set up. Currently, they are at maybe 118 odd hotels. And therefore, there's a very, very strong growth pipeline in terms of the hotels that they are going to be putting up. How are they going to be funding this? And is it just going to be management contracts, or is it going to be how many are going to be owned and how many are going to be managed? So that's the number 4 point actually. Let's pull that one up as well. Owned versus managed, what's that ratio going to be like at 350 when they get there? And this is a target they've given by FY30. The fifth piece is with regard to margins. Now margins have fallen, and that's because the fixed cost has gone up. And typically when the fixed cost goes up, you'll hit a certain scale with that same level of fixed cost, and therefore I want to understand what the margin upside is. The guidance is FY27 will start to see margin accretion, but how much scope is there for that margin improvement is what I want to know. And the last piece is with regard to FY26 cash PAT guidance. They've said that cash profitability is going to be at 70 crore in FY26. Now, while that is very healthy, my sense is that they've already done that trailing 12 months at the end of Q1. And if Q2 is strong with GST and with H2 is strong, I beg your pardon, and plus you have that GST lever which will give it additional tailwind, can there be an upside to that guidance? And therefore, where do they invest that capital? So all of that is what we'll try to dissect. And of course, we'll first start with about the company. Mahima, you want to start with that?
Sure. So basically, as Harsh mentioned, it operates and manages hotels, resort, as well as hospitality services, focuses mainly India, small presence in Nepal as well as Sri Lanka. The company follows asset-light model, plans to triple its size when it comes to 2030. The target right now market is business, leisure, weddings, and special interest guests. In terms of where the brands are concerned for this particular counter, it includes Regenta, which is mid-scale value hotel, largest in terms of network. Then we have Royal Orchid, of course, which is focused more towards luxury properties, flagship of 5-star luxury properties. Iconica, now this is new upscale lifestyle hotel that they have in their portfolio, the first one in Mumbai, of course. And then Regenta Palace, Regenta Z, and Crestoria. These are the three ones. Each caters to different segments, that is youth, boutique, as well as budget hotel. So this is the entire brand portfolio that Royal Orchid has under its name. In terms of the product mix, well, roughly 55% plus of their overall breakup is the room stays, that is the room rent comes into this part, then around 33% is F&B and others is around 12 odd percent. In terms of the operating models, owned is a very small number for them. In terms of the other services, of course, that includes your banquets, event, weddings, loyalty programs, etc. With regards to where the operating models are concerned, owned hotels, like I said, is a small number. Flagship hotels, example Bangalore, that basically means that's a very small number, but in terms of the leased and revenue share, that pays fixed rising lease, enjoys higher share in profit. So that's the managed and leased part that Harsh is talking about, leased part that Harsh is talking about, and then managed and franchisee. Now this earns management fees or franchisee fees. So this helps hotels grow because it's low in capital and low in risk as well, but the growth coming in as a part of management fees helps a lot in terms of, and plus not capex heavy, right? So that helps company earn in a better way. So that's with regards to where the operating models are concerned with regards to where Royal Orchid stands. So this is the overall view.
So I just want to understand this slightly better. So one is you own the hotel itself.
Yes.
So you own the land, you build the hotel, so that's high capex. The second way of doing this is someone else owns the land, someone else owns the hotel, and you run it for them, which is managed. And then the third way of doing this is someone else owns the land, someone else owns the hotel, you pay them a lease and you take over the hotel. Correct. Is that the right way to think of it? And in terms of the managed hotel side of things, it is their brand.
Correct.
And they earn a franchisee fee on it.
Management fee, correct.
And they determine the quality of the service and the manner in which the service is provided to the customers.
So that the brand name is maintained, yes.
And they provide a platform for customers to come in and book rooms as well.
Correct.
Okay. Anything else with regard to
I think this sums it up, right? This sums up the entire model. And I think a lot of hotels right now, just to give viewer a perspective, moving towards that asset-light model, because that helps them not to invest much, because that requires funding as well, debt or equity, whatever. And at the same time, doing capex right now for a lot of companies may not be the right way to expand as well. So asset-light is the way a lot of people are going. Hotels are going.
Well, yes, that is the new terminology in the hotels business, asset light. And they don't own it, but they do ensure that it is being run far more efficiently than a typical hotel does. But just the tailwind of growth, right? Let's talk about all of the metrics that we'll be discussing today with regard to our Royal Orchid. We'll start off with the income statement, the balance sheet, the cash flow, the return ratios, the shareholding, the street cred. We don't have any street coverage. So therefore, we'll do outlook, and thereafter, we'll look at the valuations and how that stacks up. Mahima, income statement.
Right. So, healthy financials when it comes to the income statement as well. If we take a look at the 3-year CAGR of how the revenue has grown, it's been a CAGR of 32% in the past 3 years. EBITDA has grown at the CAGR of 34%. Even in terms of margins though, have come off a tad bit versus where they were in FY23 at 35%, FY24 at 30% to 28% in FY25. We'll have to, ask the management as to what the margin trajectory from here on looks like. In terms of net profit, the CAGR has been around 17%. Not matching the way EBITDA has grown, of course, but has grown at a steady state. With regards to where Q1 numbers stand and how YY numbers have stacked up in terms of Q1 FY26, overall revenue has seen a growth of around 8%, EBITDA a growth of 18%, and net profit a growth of around 22%. Now, in terms of how the revenue breakup stands, room rent is around 50%. This is as per the Q1 numbers. 50%, F&B around 34%, and others is around 16%. In terms of the overall operational metrics, average occupancy for JLO hotels was around 69%. The average room rate stood around 5488. So the GST that we've been talking about, right? The GST on hotels is an interesting one, because the hotel industry was not expecting a 5% rate without ITC on room rate below that 7,500 mark.
But that's optional.
That's optional. And if you want to go for ITC, you'll have to pay GST at 12% and get ITC below that 7,500 rate hotels. And probably, you know, their portfolio, we'll have to ask them as to how much of their portfolio falls in that range and what option they would want to go for. So that's with regards to the GST.
That's something else we want to know.
That's something else we want to know. So that's with regards to where GST peg stands. And overall, I think in terms of where the income statement performance stand, it's been a good growth for the company. We've just given it a neutral rating, considering first thing the GST into consideration, and secondly margins picture. Where we'll have to get an idea as to how the trajectory from here on looks like for the company.
The profit growth hasn't been commensurate to the top line growth. 30% top line growth is very, very good.
Correct.
But the profit growth hasn't really translated in that sense. I'm not okay. That's the way we look at it. Let's look at the balance sheet now, and in the balance sheet, let's look at first off the total equity capital. It's around 230 odd crore. Mind you, it's a 1,400 crore market cap company, so that's your price to book. Therefore, the borrowing number stands at around 100 crore, and this includes short-term plus long-term borrowings, excludes lease liabilities. This is not a number we've picked up from the presentation. This is a number we've picked up straight from the financial statements. So this might be different versus the number in the presentation that you'll see. The cash bank balances look fairly healthy and allows for a bit of expansion, and at the same time it's also a cash generating company, because typically if you're in the hotel business, you will first generate cash and thereafter you'll see occupancy. So broadly, it's there's no concern with regard to that cash balance also sitting in, versus the total book value also looks fairly healthy. So we've given this a thumbs up. Cash flow, Mahima.
Right. So in terms of cash flow from operations, you know, overall, if we take a look at how past 3 years have panned, and you know, earlier also we were discussing as to you know, how this should be ideally analyzed, and Harsh and I were talking about it as to the ratio of cash flow from operation to PAT, and that has been kind of decreasing, but still at a healthy rate of around 53%. So it's not at all concerning as to where this particular ratio is concerned. So the overall revenue, the cash from operations is getting translated. The PAT number has
that is
remained.
The way in which the business works, Mahima, because it's a hotel business. Typically, you will first have bookings coming through, and thereafter you will have your guests coming through.
Correct.
And therefore, no surprise that the CFO to PAT is positive. I believe they've been making certain investments from the revenue expense.
Correct.
To a certain extent, which for the hotels that they've been taking over as well, because they need to refurbish those. For example, they've recently taken over a hotel and they've done a 15 crore rupee OPEX on that hotel to try and refurbish it. And those expenses also kind of get built into this. But for the moment, the overall cash flow from operations to PAT looks fairly healthy, and therefore we've given this a thumbs up. Let's look at return ratios. Okay, so let's pull those up, and what you'll see is they've been fairly healthy. See, FY21 was a tough year, understandably, it was COVID. FY22 also was a fairly tough year because we were just bouncing back from COVID. The second wave of COVID was in Q1, if you remember. But FY23 onwards, they've been fairly good in terms of where the ROCE is concerned. You'd want to see whether this can sustain, and if margins will go up, you'll inevitably see ROCE go up. But you want to keep your eye out on the C part of ROCE, which is the capex that they do, and therefore, can they continue to maintain this ROCE? Well, currently at 17%, looks fairly healthy. Does not seem to be much of a concern. But the shareholding pattern, Mahima.
Right, so it's a well-held company, Harsh, for sure. I mean, the promoter holding has remained stable, 63.6, 63.7, 63.8%. Even FIs has slightly increased their stake, you know, in the past 3 odd years. It's gone to around 7.72% as of June 2025. DIs, well, they don't hold much in this particular counter, but public holding has also, you know, fairly remained in that 27 to 29% range, currently at 27.6% range. But it's a well-held company, and that's why we've given it a thumbs up. Okay,
let's talk about the street cred. And within street cred, if you look at the near-term numbers, fairly solid in terms of returns. It's been a 7-bagger plus over the last 5 years. So even those returns fairly healthy from the COVID lows. Of course, that's something to be factored. But again, fairly healthy. No complaints there from a short-term or a long-term perspective. We've given that a thumbs up. Mahima, I'll request you to cover both valuations as well as outlook.
Right, so valuations, as compared to peers is looking attractive right now, because if you consider something like a Lemon Tree, EIH or Indian Hotels, they're trading at what, 58 times, 70 times, EIH at 33 times. But something like a Taj GVK is slightly cheaper than Royal Orchid at 23.7 times, but Royal Orchid trading at 31.8 times versus its peers. So we've taken a conservative approach here, giving it a neutral rating, because as compared to peers, it's it looks cheaper, but overall 31.8 times, it's not cheap when it comes to valuation, and that's why we've given a neutral rating when it comes to valuations. Lastly, in terms of the Vision 2030 and the growth strategy that the company has outlined, they plan to triple their hotels by 2030, growing keys to almost 22,000. The FY26 cash profit that Harsh talked about at the start of the show will grow to around 70 odd crores is what they've aimed at in FY26, and 75 crores in FY27. Overall outlook seems very positive when it comes to this particular counter, and that's why we've given it a thumbs up when it comes to the overall outlook and guidance given by the management. Okay,
all right. So that if I stack up all the valuations, that gives it a very healthy 6.5 on 8 in terms of the KYC rating. If I stack up all of the metrics. Now let me go across. We have Mr. Amit Jaiswal, the CFO of Royal Orchid Hotels, joining us live at this point. Mr. Jaiswal, hi, good morning. This is Harsh here. I want to first start off by understanding from you what component of your top line is 7,500 and below, because that's where a large part of the benefit lies, as Mahima was pointing out to viewers. What part of it is in that category? And also give us a perspective on what you're expecting in terms of a demand push as a result of purely this GST piece playing out. What's the likelihood?
See, if you look at our ARRs, we are averaging around 6,000. So that you can make out that almost 85% of our company's rooms are being sold at less than 7,500. It's only in some of the high-end hotel, wherein the suite rooms and all are sold at above 7,500, and maybe in some seasons, like in Goa, November, December, we sell at a higher ADR, the rooms and all. So fairly largely, if you look at it, 85% of our revenue is below 7,500 ARR. So we will have to change the GST accordingly. Okay, and as far as the effect of GST, definitely it is a booster. The foreign traffic, we have become competitive to all our neighboring countries with this GST rate, that is Thailand, Sri Lanka, Vietnam, Dubai, and other Sri Lanka and all like that, all these countries where the GST rates are little lesser. Earlier we were at 12% and 18%, whereas they all were between 7 to 10%. So we have become competitive. So there will be a growth in the revenues as well as the occupancies overall basis. Yeah.
Okay, Mr. Jaiswal, hi, Mahima also joining in. Just want to get a sense, because now we have two slabs, right? 5% without ITC and 12% with ITC below that 7,500 mark. Just want to understand what is more beneficial for a company like you, because if you have ITC at a higher rate, then giving output GST at 5% without ITC will not be beneficial. So just want to understand that part of business.
You're right, Mahima. See, if you really look at the financials, then definitely without ITC will not work very favorable as far as the financials are concerned. But as I said, if this drives traffic, if my occupancy, suppose I'm at 70%, it goes to another 5-6% growth I get in the occupancy, then definitely it will overall, in the scheme of affairs, it will affect. But directly, if you really look at it, as most of our hotels are under revenue share model, wherein we pay the lease rent on which 18% GST is there. So we will have a issue if we don't get the ITC. But I think overall perspective, if you really look at it, it will boost the overall revenue and the occupancies. That's where we have to encash.
Right. Sir, talk to us about how Q1 and broadly tell us how trends in Q2 have been. So we'll talk near term first, and thereafter we'll zoom out a little bit, talk about FY30 and how you get there. But just in the near term, in FY26, you've guided for a 70 crore cash profit. You've done that on a trailing 12-month basis at the end of Q1. Just wanting to understand, does this give you comfort to up your guidance, if at all, and how is Q2 going to likely be? Or even if you can't talk about Q2, talk to us about H2. Is it going to be extremely strong given GST, and therefore would you be tempted to up your guidance?
See, as far as the Q1 numbers are there already, we have posted a good profit. We have been able to work on our cost. See, we invested in last year, our costs were a little high. Now that we have controlled it with all our investment over. So I see the numbers, if you really look at the revenue numbers, it may grow in a, 8%, 9%, but our profit numbers will definitely grow. And as far as H1 is concerned, H1 till now it is good, okay, and H2 looks very good. We have a lot of bookings on the card, and the hotels are doing well. However, the Goa market is little sluggish. The Goa market has been sluggish because of several other outside issues which are prevalent in Goa right now. However, overall, the company is bound to go do well in this financial year, and definitely the cash profit is helping us in growing more leased models.
So you spoke about Goa. Can I also push you to talk about Nepal? What's happening there?
See, Nepal is in a turmoil right now. All the travels are, I think, it's standstill with so many local issues there, and also Nepal is having a very, very bad. In fact, all our neighboring countries in the last couple of years, if you see, had a lot of issues. Whether it is Pakistan, Bangladesh, Sri Lanka, everywhere, and Nepal also now has touched the same thing, and so the travel to Nepal right now is ruled out from India.
Okay, Mr. Jaiswal, you plan to triple your keys by FY30, 2030. Just want to understand as to how the funding will be done for these expansions, and what will be the ratio between these hotels between owned and managed?
Yeah. So if you really look at our presentation, which we have, it's there in the public domain, we are not going to own any hotel from here till next 5 years. The route to develop our group is only through two patterns. One is the flexi lease, which we call revenue share model, and another is management. Now, in management, we don't need to invest a single rupee. There's no investment as far as the management business is concerned, and 80% of our growth will come from that route only. Now, 20% we are targeting the growth is to come from the flexi lease revenue share model, wherein there will be investment, but the investment is very, very minimal. Like hypothetically, if you really look at it, 80-room hotel, if we take it on lease, we give some 6 months deposit, which is around 1.5, 2 crore rupees, and some working capital, 3-4 crores we need for doing that hotel. So for that, I don't think we need a lot of money. Funding is not required because we are generating cash. Our financials are quite very strong, and we are generating internal cash. With that, we will do, and maybe a little bit if something is required, then we'll look at that particular opportunity. That we have just now opened our hotel in Mumbai, that is the Iconica, where we have invested some 20 crore rupees, and we had to borrow from the bank to do that. But that hotel is going to give a big boost to our overall scheme of affairs and the revenues as well as the profit.
So you're sitting on 60 crore of cash. You will generate around 70 crore of cash profit this year, and thereafter, my assumption is it will only go higher. In fact, the sense is that you'll likely beat that number already in FY26. What do you do then with the cash, sir? Where is it that you're...
No, that's what I told you, that when we do a leased model, we need to invest some money there.
Okay. Yeah, I understand that, sir. But that's a smaller component.
Depends on the size of the hotel. Like if it's 80-room property, around 7-8 crores we need to do that hotel.
Okay.
And our payback period is 2 years.
Got it. And therefore, how does the debt picture evolve, in your opinion?
Debt will revolve around this much. Right now, we are at around 90 crores debt overall of the company. So the debt will remain the same because, if we get some good opportunity of long leases, wherein we need to put some 10-20 crores. We'd like to put it with the repayment, whatever we repay, we will again involve that and put it that money in the. See, because Iconica is it's an upscale brand which we have just launched, and we are planning to do 8 Iconicas in next 5 years. So every Iconica will need some 10-20 crores, but we are not going to borrow too much from anybody.
Mr. Jaiswal, quick question on margins. What is the trajectory looking like, especially from here on, because you'll not be doing a lot of capex, but you'll be adding a lot of keys, so that should flow into margins as well. What do you think? 2 or 3 years down the line, you'll be able to come back to where you were, around 30-32%, in that range?
No, please understand, Mahima, please try to understand. Our model of business is management and as well as leases. So the margins the percentage of the margin in leases is lesser than owned hotel. See, owned hotel typically earns around 40%, 45%. But whereas this leased and the revenue share model, which we are doing, wherein we are not putting a lot of capex. So there the margins are much lesser, because we need to pay out from our margin the lease rent to the owners. Okay, so after that the left out percentage margin is less, but overall our absolute number is going to grow in a big way in next 5 years. Our ROC, the most important factor of Royal Orchid is the ROC. We are having a very strong ROC which is hovering around 20%, which we want to take it to 25%. That's the model we have built.
How quickly do you get there, sir? Timing. Sorry, I just have 30 seconds.
Yeah, come again?
How quickly do you get there? 25% ROC.
No, that's what I'm telling you. With lesser capex, I'm doing more hotels.
Fair.
So, and the margins which will come, it will improve my overall ROC.
Understood. How quickly do you get to 25%?
Come again?
How quickly do you get to 25% ROC?
5 years. That's the time we are putting. 3.5 years, we should be able to touch and maintain it for 5 years.
Understood. Okay.
We have made for 5 years.
Wonderful. Thank you so much, Mr. Jaiswal, for coming in and speaking to us. Well, that's all the time we have on KYC today. KYC only on NDTV Profit. Thanks so much for watching. From Mahima, myself, and the entire team that puts this show together. NDTV Profit. Continue to watch us. It's for your profit.